Have you ever really stopped to think about the invisible architects of our modern world?
Mm.
Those tiny, intricate brains tucked away inside, well, pretty much every electronic device you touch. Your car's navigation, that smart thermostat on the wall.
They're everywhere.
Exactly. Quietly orchestrating everything. And right now, one company is making a very deliberate and frankly incredibly expensive bet on being the absolute backbone of that digital existence.
Powering our future, really.
Yeah, with foundational components you might never even notice. Today, we're taking a deep dive into Texas Instruments, or TXN, a true giant in the semiconductor industry.
That's right. And for this deep dive, we've really dug into a comprehensive investment research analysis. We've pulled from detailed corporate profiles, really scrutinized their financial reports.
The numbers.
The numbers, yeah. Examined forward-looking industry forecasts and sifted through a lot of competitive intelligence.
So what's the goal here?
Our mission, basically, is to dissect TXN's strategic moves, understand its financial resilience, especially through these recent economic cycles, and pinpoint its exact position within this incredibly dynamic tech landscape.
Okay.
Think of this as your shortcut, to truly understanding what makes this company tick and why its strategy is so relevant right now.
So we're going to unpack their core strategy, explore the, let's face it, often volatile industry they operate in.
Definitely volatile.
See how they stack up against their pretty formidable rivals, and then really open up their books, get into the financials, understand the real story behind those numbers. As we begin, what immediately stands out to you when you think of a company building these fundamental pieces, these unseen hearts of our tech world? Okay, let's start with the basics then. Who exactly is Texas Instruments?
Right. So TXN is a global semiconductor company. They design, they manufacture, and they sell analog and embedded processing chips.
And when we say global, we're talking...
Massive scale, right?
Yeah.
Oh, absolutely massive. A truly diverse customer base, exceeding 100,000 customers worldwide.
Wow.
They are, in essence, a foundational supplier, kind of woven into the very fabric of the electronics ecosystem.
Okay, foundational supplier. And their core products, analog and embedded processing chips, what do those actually do? They're not the famous CPUs, are they?
No, exactly. They aren't the flashy processors grabbing headlines, but they're absolutely essential. Think of analog chips as the unsung heroes.
Okay.
They're the components that process real-world signals, things like sound, temperature, pressure, light, even power fluctuations.
So bridging the physical and digital worlds.
Precisely. They let devices sense and react to what's happening around them. Embedded processing chips, on the other hand, they're more like the brains of these devices.
The brains. Got it.
Yeah, microcontrollers, specialized processors. They execute specific instructions, manage dedicated functions within an electronic system.
So not the main computer brain, but specialized brains for specific tasks.
Exactly. Again, not the high-performance CPUs or GPUs in your gaming PC. These are the ubiquitous fundamental components you find in virtually all modern electronics, from a simple IoT sensor to, the complex control units in a self-driving car.
And these two categories make up most of their business.
Over 90% of TXN's total revenue. That tells you right there they have an incredibly focused, very disciplined business model right at the core of our digital infrastructure.
Okay, incredibly focused, products everywhere, fundamental. But what drives them? Our research really highlighted this clear, consistent corporate strategy, maximizing the long-term growth of free cash flow per share, FCF per share. Why that specific metric? Why not say just growing revenue or net income, which people might be more familiar with?
Yeah, that's a great question, and you've hit on the absolute core of their owner's mindset, as they call it.
Owner's mindset.
Management firmly believes FCF per share is the primary driver of shareholder value over the long haul. It's the most effective measure of their performance.
How so? Define free cash flow for us again, simply.
Think of it like your personal savings after all your essential bills are paid. Rent, groceries, maybe that phone bill. It's the money you truly have left over.
The actual cash.
The actual cash you can choose to invest or spend or save. For TXN, it's the cash they generate after covering all their operating costs and those massive capital expenditures, the CapEx for new factories.
Right. Building those factories costs a fortune.
Exactly. So FCF is the real money truly available to shareholders for dividends, for buying back stock, maybe paying down debt.
And that's different from net income, how?
Well, net income is important, obviously, but it could be influenced by non-cash expenses, things like depreciation, amortization,
Accounting stuff.
accounting stuff that doesn't represent actual cash going out the door in that period.
Mhm.
FCF gives you a much clearer picture of a company's actual cash-generating power.
Oh, okay.
So because of this belief, maximizing FCF per share isn't just some phrase in an annual report. It's the foundational logic. It dictates every major decision, how they allocate capital, how they prioritize R&D. It's their North Star.
That's a powerful focus, cutting through the noise to the raw cash power. So that's the why. But how do they actually do it? What are the bedrock advantages allowing this? Our sources show TXN's model is built on 4 competitive advantages, kind of self-reinforcing pillars designed for durability and profit.
Exactly. It's a system.
The first pillar, their advanced, internally controlled 300mm manufacturing technology.
Yes, and this is truly a cornerstone of their whole long-term vision.
Right.
TXN is deeply committed to manufacturing its own chips internally, and specifically, they are leaders in using 300mm wafers.
Okay, 300mm, why is that number important?
It's about economics, primarily. An unpackaged chip made on a 300mm wafer costs about 40% less than one made on a 200mm wafer.
40%? Wow.
Yeah, and many competitors still heavily rely on those older, smaller 200mm wafers. So right off the bat, TXN gets a significant structural cost advantage to directly boost their margins.
So it's cheaper, but is there more to it than just cost?
Oh, definitely. Owning and controlling their own factories, their fabs, gives TXN far greater control over its entire supply chain.
Which is huge these days.
It's become incredibly critical. We've all seen the headlines about supply chain disruptions, right? In this era of, let's face it, escalating geopolitical uncertainty, being able to offer customers geopolitically dependable capacity, mostly from their U.S.-based factories, isn't just a nice-to-have anymore. It's a crucial strategic differentiator.
So it's security and reliability, too.
Exactly. It's not just about cost savings now. It's about being a secure, reliable source for your customers in a pretty volatile world.
That sounds incredibly compelling, this 300mm advantage. But playing devil's advocate for a listener, what are the downsides? Is there a risk to being so vertically integrated, especially when building these super expensive factories?
That's an excellent question.
Yeah.
And yes, definitely not without challenges. The main downside or risk is just the sheer capital intensity. The cost. Building and running these state-of-the-art 300mm fabs needs billions, multi-billion-dollar investments up front.
Yeah.
And they need to run at high utilization rates to be efficient.
So if demand drops.
Exactly.
Yeah.
During an industry downturn like the one we've seen recently, those high fixed costs weigh heavily. They impact profitability, they impact returns on capital, at least in the short term.
Okay.
But TXN's management sees this as a calculated trade-off. They're betting that the long-term cost advantage, the better control over quality and supply, and that geopolitical dependability will far outweigh these short-term financial pressures. It's a long game. They're willing to endure some cyclical pain for that eventual strategic win.
That clarity is really impressive. Okay, so structural cost advantage, supply chain security, foundational stuff. The second pillar they rely on is their incredibly broad product portfolio.
Indeed. TXN boasts one of the industry's most extensive product portfolios. We're talking over 80,000 distinct analog and embedded processing products.
80,000, that's staggering.
It is, and this sheer breadth is a huge strategic asset. I mean, you're an electronics designer, right? You need maybe dozens of different chips for your new gadget.
Yeah.
Having such a vast catalog from one single reliable supplier, that simplifies your design work, your sourcing, your supply chain management. A big deal.
Makes life easier for the customer.
Definitely. And this diversity also mitigates TXN's own risk. They aren't overly dependent on any single product or any one customer or any specific end market. It spreads their risk across countless applications and industries.
Any way to quantify that reach?
Well, one interesting point from our research, their website, ti.com, reportedly gets twice the visitor traffic of their main competitor sites.
Twice? Why?
Largely because the product catalog is just so comprehensive and easy to access. This huge digital storefront isn't just a website. It's a direct channel serving tens of thousands of customers across countless applications every single day. It's like a one-stop shop for designers.
A vast digital storefront. Powerful image. Which brings us neatly to their third pillar, extensive market reach and this deliberate shift towards direct customer relationships.
Yeah, this is a really significant strategic evolution for TXN, especially over the last say 5 years or so.
How so?
They've intentionally moved away from relying heavily on third-party distributors. Instead, they're cultivating direct relationships with their customers.
Cutting out the middleman.
To a large extent, yes. As of 2024, about 80% of their revenue was transacted directly with the customer.
80%. That's a huge shift from what was it before?
It was only about one-third back in 2019. So it's a substantial leap, showing real commitment to this change.
And the benefit of going direct.
Several big ones. This direct model, supported by TI.com and their global sales and applications teams, gives them much deeper firsthand insights into what customers actually need, what they're designing.
Feedback loop.
Exactly. It fosters stronger, stickier relationships because TXN becomes embedded in the customer's design process, almost like part of their R&D team.
Makes sense.
And crucially, it creates more opportunities to sell a wider array of TI products into each design. They call this increasing content per device.
So selling more chips per gadget.
Basically, yes. Imagine understanding exactly what your customers need for their next big innovation right from the start. That's the power here. It improves customer satisfaction and builds market share over time.
Understand needs, boost content per device. Sounds like a winning formula. And the fourth pillar, diversity and longevity in their end markets, especially industrial and automotive.
Yes, and this is where the long-term value creation really comes into sharp focus. TXN has strategically increased its exposure to the industrial and automotive markets.
How much are we talking?
Together, those two sectors made up about 70% of their revenue in 2024.
70%. Okay. And why are those markets so attractive?
They have two key characteristics. First, a large fragmented customer base, meaning no single customer has too much leverage.
Right.
And second, crucially, very long product life cycles.
Long life cycles, meaning?
Think about a critical chip in, say a car's anti-lock braking system. Once that chip is designed in, tested, certified, changing it is a major hassle. Costly redesigns, recertifications.
So customers stick with it?
Exactly. That's why TXN chips designed for these sectors often stay in production for 10, 15 years, sometimes even longer, maybe even outliving the car itself.
Wow. And the benefit of that longevity.
It provides incredibly stable, predictable revenue streams. It ensures that the returns on their big R&D and capital investments, which are substantial, are realized over a very extended period. They talk about a high terminal value for these products. It's a market that really rewards reliability and long-term support.
Okay, that's a lot of individual pieces, the factories, the huge product list, direct sales, these stable markets. How do they all connect? What's the, the master plan linking these pillars, the aha moment?
The real aha is how brilliantly interconnected and self-reinforcing they all are. It's like a finely tuned economic machine. Okay, think about it. The high-volume, long-life products needed by those fragmented industrial and automotive markets. They provide the stable, predictable cash flow needed to justify those massive investments in 300-millimeter manufacturing.
Right, the factories need the volume.
Precisely. Then that structural cost advantage and dependable supply from the factories combined with the vast product range that feeds their direct customer relationships. It creates this strong bond with designers.
All loops back?
Exactly. It's not just a random collection of strengths. It's a powerful, cohesive strategy where each advantage reinforces the others. It drives this capital-intensive, margin-focused, highly integrated business model that's really designed for enduring profitability and ultimately hitting that goal, maximizing free cash flow per share.
That's a fantastic synthesis, a self-reinforcing machine. Okay, so with that robust strategic foundation clear, let's zoom out. How does this giant Texas Instruments fit into the wider, often tumultuous world of semiconductors? Now that we understand TXN's internal engine, let's talk about the highways and headwinds it faces out there in the broader semiconductor world. I mean, this industry isn't just foundational, it's growing at an astonishing pace.
Oh, absolutely. Global semiconductor sales hit, was it $630.5 billion in 2024?
Huge number.
And projections show impressive growth, like 11.2%, pushing it towards $701 billion in 2025. And get this.
Yeah.
Industry forecasts suggest a trajectory toward $1 trillion in annual sales by 2030.
$1 trillion. Wow, that's a dizzying trajectory. What's driving that kind of growth?
It's not random, that's for sure. It's propelled by powerful, undeniable secular trends that are literally reshaping our world.
Like what?
We're talking the explosion of artificial intelligence, AI everywhere, the widespread rollout of 5G, and people are already talking about 6G communications,
Right.
the rapid evolution of autonomous vehicles, self-driving cars, And just the broader Internet of Things, the IoT ecosystem, connecting everything.
All needing more
More
chips.
and more sophisticated chips driving consistent long-term demand. However, and this is critical,
The catch.
the catch is that this industry is historically known for its cyclicality, its ups and downs.
Right, the boom and bust cycles.
Exactly. Over the past 3 decades, we've seen no fewer than 9 distinct cycles of growth and contraction, boom and bust. Understanding this inherent ebb and flow is absolutely crucial for any company in this space and for us analyzing them.
Like a farmer planting seeds in winter, knowing spring will come.
That's a great analogy, knowing the cycle even when things look tough.
Okay, so big growth, but cyclical.
Yep.
Let's zoom in on TXN's core markets, analog and embedded processing. What do those look like specifically? Size, growth drivers.
Let's break them down. First, the analog market. This is where TXN is the undisputed leader. Remember, these chips process real-world signals.
How big is that market?
It's valued at over $100 billion in 2024, and it's projected to grow at a compound annual growth rate, CAGR, of about 5.9% through 2034, so reaching around $180 billion. Steady growth.
And the biggest driver for analog?
Far and away, it's automotive. Cars.
Makes sense with EVs and all the electronics.
Exactly. Automotive represents about 32% of analog demand in 2024, fueled by electric vehicles, EVs, and all the advanced driver assistance systems, ADS, which need a ton of analog content.
And geographically?
Asia-Pacific is the biggest market currently, about 45% of global sales, mainly due to all the electronics manufacturing there.
Okay, that's analog. What about embedded processing, the brains?
Right, the embedded processing market, microcontrollers, processors acting as the device brains. This market was valued somewhere in the $21 to $23 billion range in 2024.
Smaller than analog, but still significant.
Definitely. And forecasts show a similar healthy CAGR between, say, 5.98% and 6.1% through 2033.
What's driving growth there?
2 huge drivers, really. One is the explosion of IoT devices.
Internet of Things, everything connected.
Right. Projected to go from over 18 billion units in 2024 to more than 40 billion by 2030. Smart sensors, connected appliances, you name it.
40 billion. Wow.
And the other big driver is, again, automotive, the increasing electronic content in cars. A modern vehicle can easily have between 70 and 100 individual embedded processors.
70 to 100, just in one car.
Yep. Handling everything from engine control to the infotainment system to safety features. So, yeah, incredibly robust growth areas, providing long-term tailwinds for a company like TXN.
Clear, secular tailwinds. Okay, but beyond market growth, there's this huge geopolitical trend, the chip race. Governments everywhere pouring billions into bringing chip manufacturing home, or to friendly nations.
The onshoring, friendshoring push.
This sounds like a massive headache for the industry, right? All this political interference. How does it connect to TXN?
You'd think it would be an industry-wide headache, and in some ways it is. But for Texas Instruments, it's actually a direct, powerful validation of their long-term strategy.
How so?
Well, semiconductors are now seen as strategically critical, right? So they're at the center of global geopolitical competition. Governments are throwing hundreds of billions in incentives to bring manufacturing capacity back home or to allied nations, reducing reliance on potentially unstable supply chains.
Like the U.S. GPS.
Exactly. The U.S. GPS and Science Act is a prime example. It's already catalyzed over $500 billion in announced private investments in the U.S.
$500 billion! That's incredible.
And the goal is ambitious. Triple U.S. domestic chip-making capacity by 2032. This directly validates TXN's strategy, which they've held for years, of investing heavily in their own internal U.S.-centric manufacturing footprint.
So what was once about cost and control?
Right, ensuring efficient production, reliable supply. That strategy is now reinforced by huge government incentives and aligns perfectly with customers increasingly wanting supply chain security.
So a risk becomes an advantage.
This convergence transforms what could be an industry-wide geopolitical risk into a distinct, powerful competitive advantage for TXN. They were kind of building their fortresses before everyone else realized the storm was coming.
That's a really insightful way to frame it. Almost sounds too good to be true, though. Are there any weaknesses to this indispensable low-cost supplier approach? Maybe something competitors could exploit with these geopolitical shifts?
It's a strong position, definitely, but not entirely without nuance, you're right.
Okay.
The low-cost part relies heavily on economies of scale, right? Running those expensive factories at high utilization. So if global demand softened dramatically for a long time, or if some disruptive new manufacturing tech emerged faster than TXN could adapt, that cost advantage could erode.
Possible, but maybe unlikely short-term.
Perhaps. Also, while their U.S.-centric manufacturing gives security for U.S. customers, TXN still has significant global revenue. Remember, about 20% of 2024 revenue was from China.
Ah, right. So demand risk, even if production is secure.
Exactly. They're not totally immune to geopolitical tensions hitting demand from key regions. Even if their production's secure here, it's definitely a balance they have to manage.
That's a crucial clarification. Okay, so industry's booming, governments are favoring domestic production, creating unique tailwinds for TXN. But how do they actually stack up against their tough competitors in this high-stakes game?
Yep.
Okay, competition. For years, TXN has been the world's biggest maker of analog chips, right? Holding a commanding market share, I think it was 19% back in 2021.
That's right.
Which was nearly double their closest competitor at the time, Analog Devices, ADI. That's some serious dominance.
It truly was. But, the landscape in this industry is always dynamic. You can't rest on your laurels.
So things have changed.
Well, while TXN historically held that dominant spot, more recent data from early 2024 suggests things might be tightening up a bit. Some analyses indicate that both TXN and Infineon Technologies now hold roughly 19.5% market share among the publicly traded analog companies.
So Infineon has caught up.
It appears so, in terms of overall analog share. This doesn't necessarily mean TXN is fundamentally losing ground across the board, but it really underscores the intense, continuous competition. You need relentless innovation, operational excellence, just to maintain that leading position. It's a constant race.
You have to keep running just to stay in place.
Pretty much, yeah.
Okay. What about the embedded processing market strategy? We know that's core to TXN too. How do they fare there?
Right. The embedded processing market, it's quite a bit more fragmented than analog, more players fighting for share.
Who are the big competitors there?
You've got strong companies like NXP Semiconductors, Renesas Electronics from Japan, Microchip Technology, ST Microelectronics from Europe. A tough crowd.
And TXN's position.
For TXN, embedded processing is definitely a core business, but remember, it's a smaller slice of their revenue pie. About 16% in fiscal 2024 compared to that huge analog segment.
And how's that segment doing lately?
It's faced some recent headwinds, actually. Revenue declined 27% year-over-year in Q3 2024, which indicates a challenging period for that part of the business.
So what's management saying?
They've been very clear. They have a strategic focus now on regaining market share in embedded processing and really elevating its contribution to that overall goal, growth in free cash flow per share. It's an area they're actively working to strengthen, leveraging their broader advantages.
Okay, clear focus. So how does TXN actually differentiate itself against these key peers? Let's look at Analog Devices, ADI, Infineon, IFNNY, and NXPI. What are the distinct strategic plays here?
Right, let's break them down. First, versus Analog Devices, ADI. The strategic contrast here is pretty stark.
How so?
TXN fundamentally is a cost-driven company. They leverage that huge manufacturing scale to compete broadly, offering a vast array of general-purpose components. Cost leadership is key.
And ADI?
ADI, historically, has focused more on specialized high-performance applications. Think cutting-edge stuff that commands premium pricing. They often target niches requiring high performance, sometimes lower volume.
So TXN for volume, ADI for high-end performance?
Broadly speaking, yes. This positions TXN more favorably for those high-volume, maybe more commoditized segments where cost is king. And financially, you see it. TXN has consistently shown superior profitability and returns on capital compared to ADI, which fits right into that FCF per share goal.
Okay. Next, versus Infineon Technologies, IFNNY.
Infineon, the big European play, they have a very strong position, especially in automotive and power management markets. Very competitive.
And as you said, they're now neck and neck with TXN on analog revenue share.
According to some recent data, yes. It signals intense head-to-head competition. But here's something fascinating and new.
Oh.
Both TXN and Infineon have reportedly entered NVIDIA's AI server supply chain.
Really?
Providing crucial power management components for those power-hungry AI servers.
Wow, okay. That could be huge.
It really could. A significant new growth avenue for both analog leaders, letting them tap directly into the booming AI infrastructure market. Very exciting development.
Definitely one to watch. Okay, finally, versus NXP Semiconductors, NXPI.
NXP has carved out leadership in specific high-growth areas within automotive, industrial, and IoT.
Like what?
Things like secure connectivity chips, RF communications, certain types of microcontrollers. Their strategy is more concentrated on advanced, specialized solutions for these high-growth spots. Often requires deep collaboration with customers on complex designs.
So specialization versus TXN's broadness.
Exactly. While both NXP and TXN are big in auto and industrial, TXN's approach is providing that broad portfolio of foundational, often general-purpose components to a much wider customer base. NXP is more about those specialized high-performance solutions within those markets.
Okay, so if you synthesize all that, what's the big picture of the competitive landscape?
What you really see is a kind of split, a bifurcation in strategic focus among the leaders.
How so?
Texas Instruments is leveraging its immense scale, its capital, to build this structural cost and supply chain advantage, dominating the high-volume foundational layer of the market,
Building blocks.
the essential building blocks. Competitors often are focusing more on winning those high-performance specialized design-ins, where their chip gets chosen for a specific, maybe cutting-edge application, and performance justifies a higher price.
So different games being played.
Different games. TXN's approach is a bet on becoming the indispensable, low-cost, reliable supplier for the hundreds of general-purpose components needed in nearly every electronic device. It's less visible, maybe less glamorous,
But potentially more durable.
potentially more durable and profitable because of the sheer volume and ubiquity. They're aiming to be the bedrock.
So when you, the listener, buy a new car or a smart appliance or even complex industrial gear, chances are super high that TXN chips are inside making it work, even if you never see their logo.
That's exactly right. And what this means for you as a consumer or just an observer of tech is that while you might not see the brand, TXN's components are enabling the functionality, the efficiency, the reliability of countless products you use daily. And the nature of this competition, with those high switching costs once a chip is designed in,
Right, costly to change.
it means brand reputation, reliability, long-term support, they really matter. Designers, once they pick TXN, are often kind of stuck with them in the best possible way. It creates super sticky customer relationships and long-term revenue for TXN.
An incredible insight into the unseen world.
Okay, but you can't achieve this kind of dominance and future-proofing without spending serious cash. Let's open up TXN's books. How are they financing this massive ambition, especially through these tricky economic cycles? All right, the financials. TXN's performance over the past 5 years, it really paints a picture of both strong growth and that inevitable semiconductor downturn. Bit of a roller coaster, wouldn't you say?
It absolutely has been a roller coaster. But instead of just drowning in a spreadsheet, let's focus on the story these numbers tell.
Take revenue, for example. It perfectly shows the cycle. Surged from, $14.46 billion in 2020 up to a peak of $20.03 billion in 2022.
Strong growth.
Then dipped back down to $15.64 billion in 2024 as the industry cycle turned.
Right, the downturn hit.
But the good news, our latest trailing 12-month data ending Q2 2025 shows revenue ticking back up to $16.68 billion.
Signs of life.
Signs of stabilization, maybe even an early rebound from that cyclical trough. But it wasn't just revenue. Profitability felt a squeeze too, as you'd expect.
That's so.
Gross margin, for instance, it was nearly 69% at its peak in 2022.
Very high.
Very high. But it compressed down to about 58% on a trailing 12-month basis. Similarly, their operating margin dropped from a peak of 50% in 2022, half their revenue dropping to operating income, down to around 35% TTM.
Why the big drop in margins?
It's an expected, even predictable consequence of their strategy. They have this high fixed-cost manufacturing model, right?
So it's expensive factories? Exactly. When they operate at lower capacity utilization during a downturn, those fixed costs hit margins. Plus, you have increasing depreciation expenses from all the new facilities coming online.
So it's part of the plan. Short-term pain for long-term gain.
That's precisely it. It's a deliberate part of their long-term strategy, accepting the short-term pain for the future gain. The numbers clearly reflect that trade-off. And just to give you a quick snapshot of some other key financial trends beyond revenue,
Yeah, hit us with some numbers.
gross profit followed a similar path, $9.27 billion in 2020, up to $13.77 billion in 2022, down to $9.09 billion in 2024, now showing a slight recovery to $9.68 billion TTM.
Okay.
Operating income, $5.93 billion in 20, impressive $10.35 billion in 22, down to $5.47 billion in 24, currently $5.83 billion TTM.
Yeah.
Net income, the bottom line, $5.67 in 20, up to $8.75 billion in 22, dropped to $4.87 billion in 24, now $5.04 billion TTM.
And finally, diluted earnings per share, EPS, what shareholders focus on. $5.97 in 22, peaked at $9.41 in 22, declined to $5.20 in 24, and now at $5.47 TTM. These numbers really paint that picture, the cyclical impact, but also those early signs of recovery.
Very clear picture of the cycle and the start of the rebound. Okay, diving deeper into their business segments, it seems pretty clear where the core strength lies, right?
Oh, absolutely. The analog segment. That remains the primary engine of the company, consistently contributing the vast majority of revenue.
How much?
In fiscal year 2024, analog revenue was $12.16 billion. That's 78% of the company's total revenue.
Wow, almost 80%.
Yeah. The embedded processing segment, while smaller, still substantial, generated $2.53 billion, or 16% of total revenue.
And has that mix been pretty stable?
Our research shows remarkable consistency over the years. Analog share has hovered right around the mid to high 70% range, 75.3% in 2020, 77.8% in 2024. Embedded processing, while fluctuating a bit, has stayed a solid 16% to 19% in that same period.
So a very stable core business, even with industry shifts.
Exactly. Very robust.
Now, TXN has this history of high capital efficiency, being very profitable. But our research shows recent metrics have moderated, come down a bit. What's the story there? What does it tell us?
Yeah, that moderation is a really critical point for understanding their current strategy. And it's entirely intentional.
Intentional decline. Explain that.
Take return on equity, ROE. Measures profit per dollar of shareholder equity. It declined from a peak over 60% in 2022.
Which is incredibly high.
Incredibly high. Down to approximately 30% on a trailing 12-month basis. Still good, but a big drop. More critically, return on invested capital, ROIC.
Which includes debt too, right? Better measure, maybe.
Arguably a better measure of how well they use all capital, yeah. ROIC fell from over 40% in 2021-2022 down to the mid-teens, maybe 16-17% recently.
Why the big drop in ROIC?
It's a direct, mathematically inevitable consequence of their strategy. Think about it. You have lower earnings because of the cyclical downturn, combined with a significantly larger capital base because they're spending billions on new factories.
Right.
Lower profit divided by a much bigger investment number equals lower ROIC.
So the focus isn't the decline itself.
No, that was expected. The analytical focus is really on this metric's rebound potential. How quickly can ROIC bounce back as that new capacity gets filled and profitability recovers? That's the key question. It's a temporary dip for a strategic purpose.
Okay, makes sense. But despite this dip in returns, they're still returning a lot of capital to shareholders.
An incredible amount, yes. Their commitment remains really strong. You see it in 21 consecutive years of dividend increases.
21 years straight. Impressive.
And those dividends have grown at a compound annual rate of 23% since 2004. Plus, consistent share buybacks have reduced their outstanding shares by 47% since 2004.
Buying back almost half the company over time.
Pretty much. And to put recent numbers on it, in the 12 months ending Q2 2025, TXN returned a remarkable $6.7 billion to shareholders.
How is that split?
$4.9 billion in dividends, $1.8 billion in share repurchases. So even while investing heavily, they're still funneling significant cash back to owners. Our detailed financial tables clearly show this commitment.
That level of return during such a heavy investment cycle is quite something. It begs the question, though. How has their actual cash flow generation and their balance sheet held up while funding this massive future investment?
Yeah, and that's where their core financial strength really shines through. Cash flow from operations has stayed remarkably resilient, totaled $6.4 billion in the 12 months ending Q2 2025.
Even during the downturn?
Even during the downturn, it really underscores the underlying strength of the business model. However, free cash flow, FCF, has, as expected, been significantly hit by all that spending.
Right, CapEx eats into FCF.
Exactly. FCF peaked over $6.3 billion in 2021, then fell to $1.5 billion in 2024, and was $1.8 billion for the TTM ending Q2 2025.
Big drop, but again, intentional.
Crucial to emphasize, this reduction in FCF is a deliberate strategic choice to fund future growth. It's not a sign the business is weak. They are spending heavily now to build future capacity and FCF generation potential.
And the balance sheet can handle it.
They maintain a very strong balance sheet to support this effort. As of end of Q2 2025, they held $5.4 billion in cash and short-term investments. Total debt was $14.15 billion, gives them a debt-to-equity ratio of about 85.6%.
Which is manageable.
Yes, very manageable for a company of this scale and profitability. It provides the stability and flexibility they need to navigate this capital-intensive phase without undue financial strain. They're using their financial muscle to build for tomorrow.
These financial moves definitely point to a company playing the long game, investing now for a future payoff. Let's dig into the operational strategy making that long game possible. Okay, operational strategy. It seems TXN's approach is centered on executing these long-term manufacturing and go-to-market plans with just incredible discipline, right? regardless of short-term market noise.
That's absolutely right. Discipline is the key word.
Our sources note they're almost 70% through a 6-year period of really elevated capital expenditures, consistently spending around $5 billion a year on CapEx.
That's right, $5 billion annually.
That's a huge ongoing commitment, especially during an industry downturn.
It is. And the rationale behind it is deeply strategic. This massive investment is laser-focused on building out their advanced 300-millimeter wafer fabrication capabilities, primarily in the U.S.
Why specifically?
Major new fabs in Richardson, Texas, Lehi, Utah, and Sherman, Texas. Big project.
And the goal of all this building?
The long-term strategic goal is to source more than 95% of their own wafers internally by 2030.
5% internal, wow.
And have over 80% of that volume produced on the more cost-effective 300-millimeter platform we talked about.
And doing this during a downturn, that's counter-cyclical investing, right?
Exactly. It's a defining characteristic of their current strategy. While many competitors might cut spending during a downturn to save cash, TXN is actively accelerating these investments. They are betting heavily that by doing this, they'll emerge from the cycle with a significant advantage in both capacity and cost structure over peers who might be caught flat-footed when demand eventually rebounds.
Planting seeds for a future harvest when others are pulling back. Bold.
It's a bold move, absolutely. And in parallel with this factory building, they've also adopted a very proactive inventory strategy.
How so? What are they doing with inventory?
They've intentionally built up their inventory levels during this recent downturn. Days of inventory rose to 241 at the end of 2024.
Wait, building inventory during a downturn, isn't that usually a bad sign? Unsold stuff piling up?
Normally, yes, it could be.
Yeah.
But in TXN's case, our research indicates this is a deliberate tactic. It's not a sign of distress.
Okay. So why do it?
It's designed to ensure high levels of customer service and immediate product availability for the next cyclical upswing.
Preparing for the rebound.
Exactly. They want to avoid the severe supply constraints and shortages that plagued the whole industry back in 2021-2022. It's about being ready, anticipating the rebound, and making sure their customers don't face delays getting the chips they need.
Very strategic thinking. Okay, this intense counter-cyclical investment is clearly core. How does their broader capital deployment framework fit in? How do they prioritize these huge initiatives while still returning cash to shareholders?
Their capital allocation framework is remarkably straightforward, and it lines up perfectly with that main objective.
Yeah.
Maximizing long-term FCF per share.
What's the hierarchy?
It's crystal clear.
Yeah.
Priority number 1, accretive internal investments. That means R&D and capital expenditures, the spending that drives organic growth.
Building the future business first.
Exactly. Funding the initiatives that will expand their competitive moat and future revenue streams after funding those strategic priorities.
Then what?
All remaining cash is committed to be returned to shareholders over time through a combination of dividends and share repurchases.
So invest first, then return the rest.
It's a consistent invest first, then return philosophy. Very disciplined approach to capital. And you could see this framework clearly in action in 2024.
Give us the numbers.
They deployed $4.8 billion in CapEx, another $3.8 billion in R&D and SG&A, selling, general, and administrative costs. That's $8.6 billion total reinvested back into the business. Significant.
And shareholder returns?
Concurrently, they returned $5.7 billion to shareholders, $4.8 billion in dividends, $929 million in share buybacks. So even during this heavy investment phase, the commitment to returns remains strong, though the balance definitely shifted towards internal investment.
What about the future? Does this heavy spending continue forever?
Management guidance actually suggests a potential moderation is coming.
Oh, when?
CapEx for 2026 is projected to be in the range of $2 billion to $5 billion.
That's a wide range.
It is. The final amount will depend on how revenue growth looks, but that flexibility and the potential lower end indicates the peak of this current heavy investment cycle might be approaching.
And what would that mean?
It could lead to a significant inflection point, a big jump in free cash flow generation in the coming years as CapEx potentially eases off. In fact, management has set a long-term target of achieving $8 to $9 in free cash flow per share by 2026.
$8 to $9. That would be a substantial leap from where it is now, right?
A very substantial leap. Shows the payoff they're expecting from these investments.
Okay. From the outside, this massive investment during a downturn, it might look like a huge gamble, sacrificing today's profits for tomorrow's capacity. How do you square that circle for someone trying to understand the long game?
It is a deliberate trade-off, absolutely,
Hmm.
but it's not really a gamble if you understand their strategic foresight, their long view.
Okay.
What you're really seeing is a strategic pause in short-term financial gratification, sacrificing some near-term metrics
Hmm.
for the prospect of building a wider, more defensible competitive moat and generating superior long-term value.
So build the fortress now, even if it's expensive.
Exactly. They're effectively building their next-gen factories and supply chain, potentially, when construction costs might be lower, maybe when competition is pulling back a bit,
Right.
preparing for the next big industry upswing. It's a classic counter-cyclical play, betting on their long-term vision, not chasing short-term market sentiment.
That's an extremely helpful perspective. Okay, this ambitious plan, while well-defined, surely isn't without challenges. Let's talk about the risks and the governance structure supposed to manage them. Okay, risks. This ambitious strategy, it raises an important question. What are the major risks facing TXN? Every company, no matter how strong, has vulnerabilities, especially in an industry this dynamic and capital intensive.
Absolutely. And our analysis highlights several key risk disclosures that investors or anyone following the company should be aware of.
Let's hear them. What's number one?
First is geopolitical and global operations risk. We touched on this. Remember, about 20% of TXN's 2024 revenue came from China.
Right. Significant exposure.
That creates significant exposure to ongoing geopolitical tensions, potential tariffs, trade restrictions, you name it. While their U.S.-centric manufacturing is an advantage in some ways,
Mm-hmm.
their global revenue exposure means disruptions in global supply chains, political instability in key regions, or just changes in trade policies could definitely hurt their operations and financial results. Management openly acknowledges these challenges even while building resilience.
Okay, geopolitical risk. What else?
Second, the inherent market cyclicality and demand volatility of the semiconductor industry itself.
The roller coaster we talked about.
Exactly. The sector is prone to those periods of high demand and shortages, followed by weak demand and excess inventory. An economic downturn or a significant slowdown in key end markets like automotive or industrial could negatively impact TXN's revenue and profitability. We just saw that happen. It's simply the nature of the beast in this industry.
Got it. Risk number three.
Competitive pressures. Even though TXN is a leader, the analog and embedded markets are highly fragmented and intensely competitive.
Lots of players.
Lots of players. TXN faces pressure from a wide range of global competitors, big guys, small niche players. If they fail to maintain their technological edge or their cost leadership, or if they don't consistently innovate their products, they could lose market share and pricing power over time. Staying ahead requires constant vigilance and investment.
Okay. Competition. What's next?
Next is manufacturing and execution risk. This is a big one given their current strategy.
Tied to building all those factories.
Exactly. Their ambitious strategy relies heavily on successfully and timely execution of this multi-billion-dollar expansion of 300mm capacity. Any significant delays, unforeseen cost overruns, or problems ramping up production at these new, complex facilities that could severely impair the expected returns on this huge investment. It's a massive undertaking with inherent challenges.
Construction, staffing, tech integration. Lots can go wrong.
Absolutely. Finally, there's supply chain and third-party reliance.
So wait, I thought they were bringing most manufacturing internal.
They are, increasingly.
Mm-hmm.
But even so, they still rely on third-party suppliers for critical raw materials, specialized manufacturing equipment, and certain specialized services. They don't make everything themselves.
Ah, okay.
Disruptions at any of these key suppliers may be due to a natural disaster, geopolitics, or just operational issues at the supplier could still impact TXN's production capacity and their ability to meet delivery schedules. It's never a completely closed loop.
That's a good list of risks. But let's put it in perspective. What about the risk of, say, a catastrophic loss here? Could the company fail?
It's important to clarify that, yes, based on our analysis, the risk of a total loss on an investment in Texas Instruments is extremely low.
Why so low?
This is a financially sound, highly profitable, leading company in an absolutely critical global industry. They have a very strong balance sheet. The primary risks we just discussed, they relate more to stock price volatility, the ups and downs caused by industry cycles and execution challenges, rather than any fundamental threat to the business's long-term survival.
Okay. Volatility risk, not collapse risk.
Exactly. And it's worth noting, too, some of their most significant assets aren't even fully captured on the balance sheet.
Like what?
Their vast intellectual property portfolio, all those patents, and those direct, sticky customer relationships we talked about. Together, those create a durable competitive advantage that's hard to put a precise dollar value on, but it's immense.
Intangible
Right.
assets.
And critically, there are no significant off-balance sheet liabilities lurking in the shadows that would present a hidden risk to investors.
That's a comprehensive view of risks and a vital clarification on the type of risk. So, who's steering this incredibly complex ship through these choppy waters? Let's talk governance and leadership.
Sure. Texas Instruments is led by a very experienced management team, deep roots in the company and the industry. Javi Vaillant became president and CEO in April 2023,
Relatively new CEO.
new in the CEO role, but he's a 20-plus year veteran of the company. Previously served as chief operating officer, so strong operational background. He's supported by Rafael Lizardi, the senior VP and chief financial officer, ensuring continuity in financial discipline and strategy execution.
And the board, who oversees management?
The board of directors is chaired by Richard Templeton.
The former CEO.
Exactly. He was CEO from 2004 to 2023, and he's been with TXN for over 40 years. That provides tremendous institutional knowledge and continuity at the very top.
Wow, 40 years.
Yeah. And the board itself is a diverse group. They've carefully balanced this long-standing institutional wisdom, people like Templeton, with fresh perspectives from individuals with extensive experience in tech, manufacturing, finance, international business. A good mix.
And what about their philosophy, that owner's mindset you mentioned?
Management explicitly states their philosophy is to act like owners who will own the company for decades.
How is that reinforced?
Largely through their compensation structure. It's heavily weighted toward equity stock awards options. This directly aligns their financial interests with long-term shareholders. It incentivizes decisions that build enduring value, not just hit quarterly numbers.
Makes sense. Any other signs of good governance? Share dilution? Accounting?
Yeah, a couple good signs there, too. They don't issue large amounts of new shares to insiders, which can dilute existing shareholders. For instance, stock-based compensation expense for all employees was only about 8% of net income in 2024. That's well below a typical 10% threshold some watch for.
And they buy back shares too, right?
Right. They actively reduce the overall share count through buybacks, further demonstrating a commitment to enhancing per share value. Also, their accounting practices appear conservative and straightforward. No recent material changes raising red flags.
Crucially,
we see no negative divergence between net income and cash from operations. Cash from operations is consistently higher than net income.
which is what you want to see, right? Due to depreciation.
Exactly. It's what you'd expect because non-cash expenses like depreciation get added back into the cash flow calculation. It indicates a healthy, transparent financial picture overall. Hashtag out outro.
Okay, so let's wrap this up. What does this all mean for Texas Instruments? We've seen they present a clear, incredibly consistent, long-term strategic vision.
Very consistent.
They're executing this massive, capital-intensive plan to really fortify their position as the scale and cost leader in these foundational semiconductor markets, analog and embedded processing. It's a bold bet, but seems built on deep strategic insight.
That's exactly right. And the current financial profile, the suppressed free cash flow, those moderated return metrics like ROIC, that's a direct calculated cost of building a more defensible, more profitable company for the future.
The price of admission for the long game.
The price of admission.
Yeah.
They're deliberately investing countercyclically, using their strong balance sheet and that resilient operating cash flow, all to capture market share and achieve superior margins in the next industry upcycle.
And the external environment is actually helping them.
What's really compelling is how the external environment, geopolitical tensions, the global push for supply chain resilience, actually validates and reinforces TXN's long-standing U.S.-centric manufacturing strategy. It turns what might have seemed like just an operational preference years ago into a significant geopolitical asset today.
Right place, right time with the right strategy.
It seems that way.
So ultimately, understanding Texas Instruments really hinges on appreciating this long-term view, right? And trusting in management's strategic execution. It's this deliberate trade-off. Sacrifice some near-term financial metrics for the prospect of a wider competitive moat and superior long-term value creation. Patience and foresight.
Well said. That captures the essence of their strategy.
Okay, so for you, the curious learner listening to this, here's something to mull over as you think about the future of tech. How might TXN's strategy becoming this indispensable, low-cost, reliable supplier in foundational components, reinforced by these powerful global trends, how might that truly redefine leadership in the semiconductor industry over the next decade?
That's a big question.
And what broader implications could that have? for technological innovation, for supply chain resilience globally as the world gets even more reliant on these basic chips, and maybe one more. Beyond the obvious IP and customer relationships, what other unseen assets might be accumulating on their future balance sheet? Assets perhaps even more valuable than the traditional numbers show today.
Hmm. Interesting thought. Hidden value.
Definitely something to think about. Thank you for joining us on this deep dive into Texas Instruments. We hope this has given you a clearer, richer understanding of this foundational tech giant.